Hello, my friend. Well, if you're in business, you might not be shocked to know that most business owners don't know what type of entity they've structured themselves in and what type of entity is best for them. There is so much confusion on entity classification, entity optimization. What should I be? Should I be a sole proprietor? Should I be an LLC? Should I be a partnership? Should I be an S Corp? Should I be a C Corp? Should I be an LLP? Should I be an LLLP? Should I be an LLLC? There are so many different designations. And you might be thinking, like many, am I in the right structure? Because I hear so much noise. And sometimes I don't hear anything. I don't even know sometimes what structure is best for me or if there is a difference between any of these structures. The problem is that not being in the right structure lays a foundation for there to be catastrophic issues later in your business. I've seen this many times where the business owner doesn't know that they've been put into a situation where they're either paying higher taxes than they should, they have no real liability protection, or that they are perhaps even being double taxed. There are many issues. We're going to cover them and uncover them on this episode. So I've been in this business for many, many years. And I've had the pleasure of helping thousands of people. And of those thousands of people, I would say less than 5% of the people I've gotten to help know what entity is the best entity structure for them. So I'm going to break those down for you on this episode. You're going to be clear on what the entities are, and you're going to have next steps in terms of how to move forward with the right entity for you. Now, I can't tell you exactly what entity you should be using. You absolutely must have a professional who can guide you through that. What I'm going to do is I'm going to share the nuances and the details about each type of entity so that you're better aware, so that when you have that conversation, you'll understand how to better approach that. And so make sure that you take good notes and that you listen closely. I'm going to talk about each of these entities. I'm going to start with the first entity, which is the sole proprietor. The sole proprietor is the most basic form of organization as a company. It's the form where you have ownership of the entity. You can be a one-person sole proprietor. And when you're a one-person sole proprietor, so in some states you can have a married sole proprietorship, and that's only in some states, and generally it's in states that have what we call a marital property states. That's why it's always important to contact and speak with a professional in your state. So the sole proprietorship requires no tax identification number. It can just be, and you can just set up your business with your social security number, go get a bank account, and you're in business. You don't even have to have a business name. It could just be your business name. You can create a DBA, or we call a fictitious name or assumed name, with the Secretary of State's office. Generally, that's what it's called. In different states, it may be called something else. And then you can be John Smith, DBA, John's Tacos, and you are off to the races. And of course, there may be some local or municipality regulations in terms of licensing. However, as far as taxes go, you can be taxed as a sole proprietor. Now, pluses and minuses of sole proprietorships. It is the most basic. It is the easiest to start. You don't need an accountant or an attorney or a professional service to start a sole proprietorship. What you do need is to be able to file your taxes on what's called a Schedule C. And this Schedule C simply files your tax as sole proprietor. Very little documentation required. You don't have to have a balance sheet. You don't have to disclose membership interests and ownership interests and loans and assets and liabilities. Those are all not required to be disclosed on the tax return. So it's very simple. It's very basic. Part of the challenge is that because you have 100% ownership, you also have 100% of the liability. What does that mean? That means that if there's an issue, this is something to consult an attorney with, that you have no protection because there's no distinction between you or your business. It's one entity. You and your business are one. That's a challenge for many entrepreneurs because they then have a single bank account for the business and themselves, and it all runs through. And it's difficult to classify what's a business expense, what's a personal expense, and to distinguish those. And so often I found that business owners have to get a separate bank account for their business so that they can delineate those individualized expenses. Because if they get audited and you can't distinguish between your personal expenses and your business expenses, there's a great likelihood that the auditor won't be able to do that either. So what happens in that case? Well, then you can't substantiate or defend that certain expenses belong to you as an individual or versus you as a business. So it becomes really mucky in terms of if there's ever an examination or an issue. So the very next logical step is to move into an LLC. And an LLC is a limited liability company. You might say, Nate, this is like rudimentary. I know this stuff. Well, there's certain things that you may not know. So listen closely, because no one is a full expert where they know everything about every aspect and every nuance. Even myself, I'm going to give you the basics. I'm going to give you the generalities. I'm going to give you some detail. This is also why it's so important to have someone who is a professional who I trust, who can help me navigate this space. So if you start an LLC, then you move from unlimited liability to what? Limited liability. That's why it's a limited liability company. So the liability is limited to the assets of the organization. And so that separates you from the organization on paper. So no longer is it John Smith, sole proprietor. It can be John Smith LLC. So that separates one degree of separation. I actually recommend the LLC for just about anyone going into business. The cost is so minimal, and it's very rare where it's not good to. It's very rare where it is good to not separate them. It's so good to separate your private assets, your personal assets, from the LLC's assets. And what happens then is, now you can get a federal tax ID number with the sole proprietorship and or with the LLC. What a federal tax ID number is, it's kind of like a social security number for the business. It's a business identification number, same 9 digits, except it's different because it's 2 digits, then it's a dash, or a social security number is 3 digits, then it's a dash. So you could be 43-575-1519. That's a number hopefully it's not someone's number. That's a number I just pulled out of my head. And then that's a separate entity. And when you go to open a bank account for the business, you will give the bank your business federal tax ID number, should be a letter, and your articles of organization from the Secretary of State, and perhaps an operating agreement, which tells the bank the percentage of ownership and how the ownership is listed. And those are generally the 3 parts of your startup when it comes to getting the business going. And now it's a separate entity. But here's what you have to do. When it's a separate entity, now that's an LLC if you're a single member LLC. If you're a multi-member LLC, then that becomes a partnership. So then it just means that I have multiple owners of this LLC. If it's a single member LLC, for tax purposes, you're still going to file your taxes on what we call Schedule C. It's the same form that you file your taxes on, whether you're a sole proprietor or you are an LLC. You say, Nate, well, what's the benefit? I mean, if I'm using the same, when and why? Why am I using the same form? Well, you're using the same form because the IRS, the Internal Revenue Service, considers you what we call a disregarded entity for tax purposes if you are a single member LLC. In other words, for tax purposes, you are not regarded as an entity. For the state level, you are regarded as an entity. So you're disregarded, so it's the same form. You say, well, then is there a difference? There is very little difference, if any, that you will have from a taxation perspective. In other words, whether you're a sole proprietor or a single member LLC, generally speaking, the taxes are the same. It's not necessarily the taxes I'm trying to separate, it's the liability, okay? So that your personal assets are not liable. These are, I can't practice law without a license, and so my attorney says, so I can't give you legal advice. I can certainly speak the tax code because I've got almost 30 years experience working the tax code. So I'm going to geek out a little bit on the tax side and the entity formation side. If you have a question regarding the legal aspects of this, consult an attorney. And so once you start your LLC, your liability is limited. However, there is a problem. And here's the problem most people face is that they get their LLC and they use their business account to pay for their personal expenses. So it's a piggy bank. So I've got an electric bill, or I got clothes I bought, or if a vacation, you name it, they bought it out of their business account, and it's a personal expense. The problem with that is we call that commingling funds, and that's not a happy term. Commingling funds is when I mingle business funds with personal funds. And the problem is that once I do that, there is no distinction between myself and between the business. So then the limited liability protection may be jeopardized. And so we don't ever want to do that. So I see this a lot where somebody will commingle funds. They'll have the business account used for personal use. That might be you. And so we want to eliminate that. We want to completely separate the business expenses from the personal expenses. So if you have a business card, a credit card, then use that only for business. If you have a business debit card, use that for business. If you have a personal card, only use that for business. I've got, believe it or not, in my pocket right now, I have 1, 2, 3, 4, 5, I want to say 6 different cards for each of my individual business units, because I'm an entrepreneur. I've got one for my real estate businesses. I've got one for my real estate, my rental properties. I've got one for my accounting. I've got one for my tax side. I've got one for my leadership development side. I've got one for personal. And I might even have 1 or 2 more. And so every time I am using an expense for a different business, I'm going to pull out that different card and I'm going to keep them separate. It's so important to keep them separate. Be diligent, be intentional. And what's going to happen is you are going to make your accountant happy too, because your accountant or your bookkeeper is going to see all of those transactions belong to that business. And they're going to classify them appropriately. If you don't, they won't know. So what'll happen is, if they're worth their salt, they'll err on the side of caution, and they'll generally ask you. Of course, sometimes you won't know. You won't remember what was what. You see a filling station. Boy, that really dates me. You see a gas station. They won't know whether it was personal or business. So you've got to make that determination. You've got to separate that. Be mindful and be good at that. So then you say, Nate, I've got my LLC, but my accountant told me I needed to be an S corporation. What the heck is an S corporation? I thought an S corporation and a sole proprietor were the same thing. I just actually had a new client ask me that. And I said, no, they're actually quite different. An S corporation is just that. It is a corporation. And that corporation can be classified as an S corporation a couple different ways. One, you can start a corporation and then elect that the business be taxed as an S corporation. All corporations start out as what we call C Corps, and I'll talk a little bit about that. And then you file Form 2553, or your accountant files it, and you are taxed as an S corporation. Now, when you become an S corporation, you have then you're then under the rules of the S Corp. You don't have to, by the way, start as a C corporation. You can start as an LLC. Believe it or not, LLCs can become S corporations for tax purposes. It's really kind of cool. It's a little bit of the best of both worlds, because an LLC, unlike a corporation, is not required to have board meetings and minutes. It's not required to have an annual report, at least in most states. And so this annual report then is eliminated with an LLC. So what we do often is we will create an LLC, and then we will elect to have it taxed as an S corporation by filing the Form 2553. And then we don't have to have all the additional requirements for the LLC, which is nice. Now, there's some pluses to that. But before I even get to that, say you have an LLC and say, Nate, you didn't really talk about an LLC as a partnership. Can that be an S Corp? Yes, it can. Once you transfer the LLC to a partnership, when you have more than one people owning the LLC, you can then still change to an S Corp election for tax purposes. Your LLC remains intact as an LLC at the state level. That does not change. But the IRS simply recognizes you as an S corporation for tax purposes. Why would you want to do that? Well, there are several reasons. One, when you're in an LLC, all of your, if you're a general partner, because you have general and limited partners, all of your net profit is taxed at the self-employment level. So this is a 15.3% tax, which is for Social Security and Medicare. And so this Social Security and Medicare is then transferred to the individual owners based on what we call their percentage of ownership and their pro rata share of income to them as self-employment tax. And there's other caveats. You can take a guaranteed payment and move some of that by each individual owner. Again, we're going to get into the weeds a little bit. These are all conversations to have with your tax accountant. You might be already thinking about turning me off because this is like total tax talk, but there are nuances to this you need to know if you own a business. So what happens then? Well, say for example, your company made $100,000 and you labored for 50, and when I say made, net profit made. So your profit after all your expenses was $100,000. And you, whether you're a partnership or whether you're a single member LLC, had a total of $50,000 in labor for that $100,000 in net profit. If you're a single member LLC, you're going to pay self-employment tax on $100,000. Now, that's if you don't have any other income, because there are thresholds that are maximized about $160,000, and then Social Security turns off once you reach that amount. But say it's just $100,000 and that's your total income. Then you pay self-employment tax on the whole $100,000. Well, you only labored for $50,000 of it. The labor of others was for the other $50,000. So you're paying 15.3%. We're going to call it on 50 grand. And so let's just say 15% for easy math. 15% of $50,000 is $7,500. So you're paying self-employment tax of $7,500. And yes, that is going into your bucket of Social Security. That is going into the bucket of Medicare. But if you're not laboring for it, you wonder, well, how and why am I paying tax? Because that's the way LLCs and single member LLCs and sole proprietors are classified. Now, if you're a limited partner, then you may not be subject to Social Security and Medicare. But if you're a general partner or general member, then you may be. And it depends. There's a number of factors depending on your involvement in the company. But certainly if you are laboring in the company, then you will be required to pay tax on that labor, plus whatever it is that you're getting in your total. And by the way, you don't actually have to take money out of a company for you to pay tax on it. It's whatever the net profit is, not what your distribution is, and not what the money that you remove from the business. And that's important because as you accumulate wealth in the business, you may find that you're paying taxes on money you haven't even taken out of the business. That's just the way it works. It's not how much you take out. It's how much is on your profit and loss or your tax return, because there may be some adjustments at the end of the day. So the IRS allowed LLCs to then become taxed as S corporations. One of the benefits of that is then you become, as an owner, you become an employee of the company. And that employee of the company, then you get a W-2 for your labor. Why is that important? That important is this, because once you take what we call a reasonable salary, and I would advise to have an independent third party such as RC Reports do a compilation and a report on what a reasonable salary is for your work that you do. And once that reasonable salary is determined, for example, if that reasonable salary is $50,000 because that's what you labored for, then you only pay self-employment tax on the $50,000. The other $50,000 that was in net profit, and whether it's distributed just to you or to other partners, depending on the ownership percentages, is then not subject to the self-employment tax. You're still subject to federal and state tax if you do have a state tax, but you're not subject to self-employment tax. And that's huge That might be $50,000, which is $7,500. It might be $100,000, might be, which is $15,000. But you have to take a reasonable salary and it has to be documented. There's different ways to do it. I like the independent third party route. There's other ways that accountants do it. There's taking a look at what your total labor is, your hours, and your abilities, and what the market will bear for that particular position. There's a number of ways to slice it. Again, you want to do this with a professional. Don't try to do this on your own. Do this with a professional. And so then I get the benefit of not having to pay the self-employment tax on all of my net profit that I did not labor for. This works out great because you then have more cash because you're paying less taxes. So that's one of the reasons why people do the S Corp election. And there are a number of nuances to that, and there's a number of different factors. And then that opens up a whole nother set of tax abilities, tax saving strategies within the S Corp realm. And I won't go through all of that this episode. It'll be on a following episode. This is really just explaining the differences of each of those ways to create a business. Now, there are negatives to that too. If you form an S Corp for tax purposes, there are limitations on what an S Corp can own in terms of other businesses. There are limitations on how many owners can be in an S Corp. So there are several limitations that preclude you from perhaps having the most advantageous route. Again, I won't go into all that, but I will tell you this, that once you determine that I don't know enough about business or my formation, that's when it's time to have that conversation. And that conversation will go deeper into this and begin to understand how many people are going to be in this endeavor, how it figures tax-wise, and how you can benefit. The last one I'm going to cover today is the C Corporation. The C Corporation is the one that you see that's publicly traded generally, like a Coca-Cola or a Disney. When you buy shares, those are C corporations, Tesla, and so on. And individuals can have C corporations too. So a C corporation is different than an S corporation in that it is not what we call a flow-through or a pass-through entity. In other words, the S corporation and the LLC, multi-member LLC, is what we call a pass-through organization. All the profits pass through to the individual owners, and those individual owners pay taxes at the individual level. A C corporation is different. You are taxed as the corporation is taxed at the corporate level, and then the individuals are taxed on any dividends they receive. So we call this double taxation. That's why it's called your double tax when you have a C Corp. Now, a C Corp, you say, why would anyone then ever want to have a C corporation? Well, there are benefits. There are a number of benefits with deductions. You can deduct certain things on a C Corp. You can't deduct on an S Corp. And the C Corp perhaps it can be a more favorable tax rate depending on how much income the individual owners have as a whole. So it's not a one size fits all. You really have to have the kind of team who will analyze this and extract what the best and most optimized entity formation the most optimized entity is. So this is where the professional comes in. Now it's time to review this with your tax pro. My advice is to take what I've taught you today and sit down with a pro and say, hey, look, I just heard a great podcast. I don't know which my entity is most optimized in. Can we review this? Sometimes it's best to review it on an annual basis with your tax pro because there may be nuances. Your tax pro might say, well, we should start another LLC for this part of your business. We should perhaps start a C Corp for this part of your business and leave the S Corp intact for this part of the business and do some advanced tax strategy and strategic planning so that your business will have the most optimized entity selection that's possible and necessary for you to do your best possible work. We geeked out a bit, and I hope that you didn't fall asleep. This is super important stuff, and it's important that you have the basic understanding of each of these entities. There's so much more with each of these that I would cover in 25 minutes, but it's a great way to introduce you to understanding these different types of business so that you can make wise choices in your business and move forward and get the right people on your team to help you to thrive.